Good morning and welcome to Cornerstone's third annual State of M&A. We're very excited to have you all here today. My name is Scott Buschke, Managing Partner and Founder of Cornerstone Business Services. This is our third annual event of State of M&A. It's virtual this year. Next year we hope to see all you together in person. But we wanted to make this our biggest and best year ever. We have over 350 people from around North America taking part in this today. We're really excited. We're also excited that it's Cornerstone's 20-year anniversary. So we wanted to, again, go above and beyond what we've done the first 2 years. And we've talked about our 20-year anniversary, and in my notes here, my assistant said, all it means is that you're getting old and I should probably take a nap soon. So hopefully when I get done with this, we can take a nap after and all is good. Shouldn't have to tell you to turn off your cell phones. Everybody's muted, so you don't have to worry about that. You should all know where your bathrooms are. If you don't know, you've got bigger problems than what's going to happen in 2021 for you guys in M&A. We've got a great agenda today. There's going to be breaks throughout every session, so you can check out the different tabs, which I'll talk about. You can communicate with and message other folks, or you can stretch your legs and get some other coffee or whatever it may be. We have our agenda starts out with our keynote speaker, which I'm really excited about, talking with Brian and all of his topic on the economy and what's going forward. We've got several different breakout sessions, but you've all have pre-chosen 3 different sessions. So we'll talk about those. We have our Shark Tank Green Bay style event. We've got 3 different private equity firms that are going to talk about a deal and how they value the deal, how they structure a deal, what they have. What were the value drivers, value detractors? It's really going to be very interesting. And then lastly, we have our Q&A, which again, you pre-selected which presenter you wanted to do Q&A with at 3 o'clock Central Time. And that'll be a 30-minute session. And then once that Q&A is done, you're off on your own for the day. Want to thank the sponsors. I cannot thank the sponsors enough. They support us. They allow us to put on a first-class event for you and bring in great speakers and our thought leaders in the topics that they talk about. The platinum sponsors are Imaginasium, Gillespie Productions, Baker Tilly, Von Briesen Roper, The Business News, Nicolay Bank, and Nicolay Wealth Management. Our gold sponsors are Journey Consulting and Leonard & Finkel Public Relations. So again, I'll show you where they're located in the platform. Please check them out. All of these folks are specialists in what they do and are happy to help and be a resource for any of you that are business owners or the trusted advisors that are on this as well for you and your clients. They are the go-to firms that you want to be working with. And some might think, I'm a business owner, I want to keep this confidential, I'm not sure if I should talk to anybody, I don't know them. Know that everybody understands confidentiality, so don't let that hold you back. Whether you guys end up working together or not, have a phone call, send an email, they will keep everything confidential. All right, let's jump into this platform, this virtual land that we've all been in now for over a year. You can see at the town hall here where the mouse is. That's where you're going to come in. That'll be your page, and it has the activity stream. So if there's any updates that we're going to put out through the day, that'll be there. But really what you want to look at there is the community. So anybody who's in there, you'll be able to message them, or they may have their phone number and email address there that if you want to email them or call them later, it's a great way, in those breaks, if you're not stretching your legs or grabbing something to drink, jump in there and message folks, and you might find some people you haven't talked to in a while or someone else that could help you or be a resource for you, because that's what it's all about is building up this community on the virtual side. Next, what we have on the left-hand side is the schedule. So if you click on that, that's where you're going to spend most of your time. And what you'll see come up is your schedule will be on the left-hand side, that third of the page, and you'll see everything is in bold. The titles are in bold. So if you click on that, it'll come up on the screen and just stay there. And then you'll see a 60-second countdown, and then it'll start. You don't have to push play. You don't have to push stop. But know that it's not going to wait. We're not going to wait for you. It will start on time and hopefully finish on time. But this is where you're going to spend most of your time is working within the schedule. Also, all of our speakers, the keynote, and also for all the presentations, they're going to be live answering questions through the chat. So it's pre-recorded, so we don't have to worry about technology, but they're going to be sitting there. So if you have any questions, type in something, hit post, and they'll be happy to answer those as best as they can. Again, if you don't want to post anything here, but this is who you chose for your 30-second live intro, you could ask them a live question or a follow-up question later. If you didn't choose that person live and you don't want to send a chat to everyone, on the left-hand side, you can see where the sponsors are and the speakers. But the speakers are all right there, and then you could click on them and click on any of those, and their information, their contact information will be there as well. So all of the information will be there, things about their firm, contact information, so you can get to know them as well. In between those two is the sponsors. Again, we couldn't do this without the sponsors, so please check out their information there. They'll have something about their company, again, contact information, good firms, great people, check that out. And then the last two, this is the one, is the feedback survey. Now, typically we hold over your head drink tickets that you don't get your drink tickets until you fill this out. Obviously, I can't do that this time, but I promise you, we will give you an extra drink ticket if you fill this out next year. So we want to make sure that we fill this out because, again, we do look at every single one of these, and it makes each event better and better. So we really appreciate your time. It take a couple minutes. It's usually probably 2 to 3 minutes to fill it out whenever you leave and be done. And then the last thing is that you want to print out is the business news supplement. This is a 16-page supplement that is all educational based. It's all articles that are education on how to build value, how to build a brand, how to buy a company, how to sell a company, legal, tax items, really great information. So you want to be able to print this out, and everybody's kind of got a folder for when they grow a company, when they're starting to think about selling the company, throw that in there because this is it, but read it first, obviously. But keep that in there because, again, these are the people you want to work with, and these also are great information. And if you're in Northeast Wisconsin and you get the business news, which everybody in Northeast Wisconsin should get the business news because it's an amazing newspaper for business, this will be in the next newspaper that comes out as an insert, so you'll get it twice. Again, as I stated earlier, there'll be a break in between each session, so don't worry about you having to stay in one to the other. You'll jump through those. And as we talked about, the speakers will all be live on chatting, and at 3 o'clock you'll have whichever presenter you chose to talk, which is going to be great to keep that as interactive as possible. So let's do this is a state of the M&A. So what's going on what happened in 2020? What's predicted for 2021? Just want to take a couple minutes and just give you a little bit of overview about what we saw at Cornerstone. First of all, 2020 was a year like none other. Nothing was the norm, pretty much. We were able to close 12 transactions last year, even with everything going on. We had a strong first quarter. Second quarter, pretty much nothing happened from March, and then third quarter, things started warming up, and fourth quarter was strong as well. But it was very interesting for me personally. I left with my wife, and we went on vacation March 3rd, and we came back on March 10th. Well, when I left on March 3rd, the economy was an all-time high, unemployment all-time low, a little talk about COVID, but not too much. And we came back on the 10th, not watching TV at all while we were gone, and it was like the world changed in a blink of an eye. And it was amazing how that mid-March things just turned off like that. And we saw that at Cornerstone. Like I said, March, April, really nothing happened. May, things started getting a little bit warmed up. We closed a few deals in June and July. But what was the interesting part is we took a deal to market in June and another one in September to market. And what we saw, which unlike the Great Recession and 9/11 and things like that, where when times of uncertainty and recessions, deal volume came down. Well, that happened. Deal volume came down. There was not as many deals done last year as possible. But typically, when you have uncertainty, values also come down. So the multiples will come down, which we'll talk more about in the Shark Tank. And you would think that happened. It happened in the Great Recession. So your business could be doing $2 million in EBITDA at a 5 multiple or 6 multiple, and the next day it's worth 5.5 or 4.5, and you didn't do anything wrong. But things just changed because of the uncertainty. Things just changed overnight. But what happened this time is those companies that were negatively affected, what we saw is those companies that were negatively affected in March, April, May, but then came back June, July, August to pre-COVID or 19 numbers, or those that weren't affected, or the small group that was actually positively affected and had a tailwind because of COVID. Those companies were kind of pandemic proof and very, very sought after. And because there were so many businesses came off the market because of COVID, and how they were negatively affected. And quite honestly, the mentality of there's COVID, there's a political election, there's civil unrest, there's just so many things going on. There's no way I could get top dollar for my business now. Ironically, because of that thought process, people that did actually test the market actually did get top dollar. And we took a company to market in September, and we closed the deal in first part of February, basically 5 months with 3 holidays. And in my 20 years, I've never had more offers. It was about 12 million in sales and 4 in EBITDA. And we had 28 written offers. It was unbelievable. We average about 3 to 4 normally, but we were able to get a lot more offers because again, what we're finding, and the other deal that we did in June had 5 offers. So what we're finding is that there's so many buyers out there. You'll hear from the private equity groups later how much money they have, dry powder, but just in private equity, it's $1.5 trillion is what I've heard is out there. So with all this competition and you kind of the Econ 101, more buyers than sellers, they're bidding these things up and they're beating each other up in value and structure. So these business owners are still getting good values out there. Now, if you're negatively affected and still negatively affected by COVID, what we're seeing is you can get pre-COVID value in most cases, but the difference between today's value and pre-COVID value will be in an earnout over 1, 2, 3 years. So a lot of different interesting things that we saw last year. Never would I have thought that values would have been at the same level during COVID than pre-COVID, or in some cases above. But again, what was normal last year at all? As far as 2021 goes, from our standpoint, what we're seeing is that people that are burnt out, a lot of times sellers sell, unfortunately, when it's not fun anymore, and COVID is definitely not fun for any of us. So we're seeing more calls coming in now that they're getting their year-end numbers for 2020. And we think also, again, it's not that total number, that purchase price number you should really care about. It's what's that net number. And that net number could change drastically with Biden's tax plan, where taxes might jump up from capital gains from 20% to almost 40% and double. And the discussions right now, and Brian will probably talk more about this, but we're thinking that right now they could start those discussions in October plus or minus of this year and kick in 2022. Hopefully that's pushed out more, but you never know with politics. But so we're seeing more people that want to try to beat that curve and get ahead of that tax. So what our goal is today and why we put on the State of the M&A at Cornerstone is really to educate you, the business owner, and you, the trusted advisors. That's what's usually in the room, but now virtually here, to give you, if you're going to take one day to learn about all things M&A, I want to grow through acquisition, I want to prepare my company to sell, I want to build my brand, I want to grow, all of those things you can capture in one day. And that's what we're trying to do here today, is bring in not just anybody to speak, but true thought leaders to speak in the niches that they know and know a lot about. So we're really excited for a day. We think, I know we brought in some great speakers and great presenters with some great topics, and I think you're going to have a great day. My hope is that for each of you, you have a great day and take away 2 to 3 things. Don't try to write down 75 different things. You're not going to do all those anyways. But what are 2 or 3 takeaways that you can take out of this to help achieve your goals for 2021, and whatever that might be, or to enhance the value of your business? But I'm guaranteed there should be, and I'm excited to see what those are for everybody. You take this day and reflect and stop and think about work on your business, not just in your business. We all get in that kind of wheel of just running the race, and we don't know, what are we doing this for anyways? When are we going to get out? How are we going to get out? What does that look like from a value standpoint? So all those things are things that we're going to talk about today in the comfort of your home or your office. But take the time to really reflect on what's important to you and what are you trying to accomplish in life. And hopefully you'll get some good pointers today to help you get closer to that goal. So with that said, this is my short thoughts on what we saw in value or in the deal flow and M&A across the country. But Brian Bolio is the expert on this stuff. He is the man, and we're so excited to have him. Nicolay was great to help open the door to get a discussion with Brian going. And Brian, just to give you a little background on Brian, but he's served as a CEO and chief economist of ITR Economics since 1987, where he researches the use of business cycle analysis and economic forecasting as tools for improving profitability. Brian has shared his highly valued research results via presentations, workshops, and seminars in numerous countries to hundreds of thousands of business owners and executives for the last 38 years. So this is not his first rodeo, he's done this before. He's co-authored The Prosperity in the Age of Decline, which is a great book. I recommend it, I read it, it's awesome. Powerful look at how to make the most out of the US and global trends over the next 20 years, as well as Make Your Move, a practical practical and insightful guide to increase your profits through the inevitable business cycle changes. Brian's also co-authored a book, But I Want It, by ITR Economics. It's their first children's book. I think, Brian, I'm going to need that for my kids because they want a lot of stuff. Brian serves actually on the board of Aaron's Company, which is just down the road south of us. And he has been quoted and shared his expertise through various media outlets, TV, radio, newspaper, magazines, all over the country and probably around the world. ITR was founded in 1948. It's the oldest privately held and continuously operating economic research and consulting firm. And they have, and this is why we really wanted Brian and his team to talk to us, with a long-term accuracy rate of 94.7. You know, I would love to make 94.7% of my decisions correctly, but they have the team, the research, and the secret sauce on how to do that. They predicted the Great Recession back in 2008, years in advance, and many other things over the last several years. So it is my honor to welcome Brian Bolio from ITR Economics as our keynote speaker today. Brian, take it away.
Thank you very much, Scott, and it's a pleasure to be here. We're going to be talking about M&A trends in the post-COVID economy, and that's a bit presumptuous, right? I mean, I would be thinking that COVID's still with us. It's still the real deal. Here are the trends and why we're leaning toward the post-COVID economy approach. We watch not only the cases, but the number of deaths every day stemming from COVID, not just here, but by country and for the world as a whole. And the trends are favorable. The cases, the deaths, they're coming down. The immunizations, there's over 73 million of them that have been shipped, over 54 million that have been administered. It is happening. It may not be happening fast enough for everybody's taste, satisfy their concerns, but the trends are there. They're positive. The only reason, and I hesitate at all about the post-COVID economy, is because of these variants, the UK strain and the South African strain, and the fact that if you've had COVID, you're not immune to these new strains, and our vaccines aren't uniformly as effective against these different strains. So we're not all the way out of the woods yet by any shot, but the economy is. So I can't forecast COVID, but I can tell you that the economy is rebounding today, and it's poised to grow even higher in the future. We're going to take a look at why we think that is. We're going to take a look at the tax situation. We're going to talk short-term, long-term, and I look forward to answering all of your questions for that matter. First, what does the M&A world have to do with the economy? Well, what you're looking at here is the total value of US mergers and acquisitions. And we can break this down into Europe, planet, whatever we want to do. We're just, for today, looking at US aggregate data. But you can also break it down into industries, obviously. The green line is US industrial production. So it is a solid benchmark of what's going on in our industrial base and really what's going on in overall GDP. And you can see that we're not time shifting this at all. There's a synchronous relationship at work. And when the US goes into a recession, the value of mergers goes down. And when the US is rising, we're going to be seeing rise as the longer term secular trend in place for the value of mergers. It's as simple as that. So when I show you that the US economy is going up in 2021, 22, 23, it means you know where valuations are going. And when I intimate that 24 looks to be another good year, that extends that horizon. And we think 25 right now is going to be a good year also. So I'm coming here with, I guess, good news, depending on what side of the equation you're on. And see, at ITR, we don't separate good or bad. It just is what it is. I lay it out there. I mean, you determine how best you can utilize the information. That's up for people like Scott and others to figure out how this best works for you. I'm just here to show you that when the economy is going up, the value of mergers and acquisitions in the US goes up. And as goes the value, we also have the number. The value is in blue, and the number of acquisitions is that thicker green line. And both got smacked by COVID, as Scott was saying. And this is the blue line is the 12-month moving average. So it's a little bit slower to come around right now, but this, you can see the rebound going on in the number, and that's what Scott was speaking to. It's recovering very quickly from COVID. And Scott, you said something that we tell our clients, and I just want to reiterate it. What we went through in 2020 was not an economic business cycle in any normal sense. What happened in 2020 was a natural disaster that had gross economic implications, some of which were externally imposed upon the economy via the body politic. But that shortens the timeline of recovery. And look how fast that green line is going up. It's not taking the same slope you have seen in prior occasions, because this economy is not broken and because there's a lot of liquidity out there. More on all of that. Switching a little bit to politics for a few moments, because I think this should be a major factor in thinking about, should I be selling, should I be buying, what's the deal going to look like? We now have an aligned government, and by that we mean Republicans are out, Democrats are in, including the Oval Office and all of Congress. I'm going to show you what that means. But before I do that, please hear me. At ITR Economics, we are party agnostic. We don't care about anybody's political party. What we care about are policies. And I also, therefore, don't care whether it's a Republican or a Democrat in any part of government. I just care about policies. The numbers I'm about to show you may make some of you uncomfortable. They may surprise some of you. We're not going to get into a political treatise or a political discussion about any potential flywheel effect. For instance, the Republicans were in office, that's why that happened 4 years later. Or the Dems are in office, and that's why that happened 4 or 8 years later. We're not going to go there. I'm going to show you some numbers simply so you can have some baseline expectations for the next 4 years. So please look at this. You're looking at real GDP growth under 4 possible political alignments, all Republican, a misalignment with the Republican president, misalignment with the Democratic president, and total alignment under Democrats. Real GDP simply means adjusted for inflation, and the time frame we're using is 1953 through 2019, so it starts with the Eisenhower administration. We did not include 2020 on purpose, for the very reason Scott was saying. 2020 came in wacky, distorted data. There wasn't much point in including it. The brown bar you see, horizontal bar, that's the median or typical occurrence. So the typical occurrence is actually better under an aligned Democratic Party than the other scenarios. The other scenarios are actually pretty close. The gray bar is the upper majority range. That defines mathematically the upper side of normal. And the blue is the lower side of normal. And under an aligned Democrat, if we come in at the low side of normal, we're going to be about median with the other alignments. So I don't take this next statement as offensive if you are ardently Republican or Democrat, but because there's a Democrat running the country and running the Congress, you don't need to fear the future. It has nothing to do with them being a Democrat. Now, what you and I need to understand, take away from this is, okay, the economy is going to grow, but there will be certain consequences stemming from taxes, but they may not be the consequences you think. This is retail sales in the United States, and this is in nominal dollars. And this is a chart you may or may not be used to seeing because we're not on a simple arithmetic scale going up and down the sides. This is a logarithmic scale chart. So you're getting an accurate percentage relationship of the data through time. And each of those brown bars is when there was alignment, either Republican or Democrat alignment. Obviously, in the 60s, it was the Democrats that had the alignment for a long period of time. So look at retail sales. with the alignments when they happen, can you tell me you see a discernible trend that, oh yeah, when there's alignment, this is going to happen, for good or worse? We can't. I mean, I've spent over 40 years looking at trends, and I tell you, there's no mathematical consequence here to alignment. The red bars, those are the last two times we increased income taxes, because an income tax increase is highly probable sometime in the next 4 years. So we want to know, well, what is that going to do to the economy? Because if the consumer is happy and we're looking at rising retail sales, then the economy overall is going to be well off. The one over on the right, that was the tax increase under President Obama. The one in the middle was under George Bush, the first President George Bush. Not much happened on the one on the right, despite all the angst and gnashing of teeth that went on at the time. And in the middle, some people would argue, well, when George Bush broke his pledge and those taxes went up, that's why we saw retail sales flatten out. And I would push back on that. And Scott referenced our track record. We forecasted that flatness was going to happen over a year before it actually occurred. It had nothing to do with the taxes. It had to do with other extant variables. And please notice that the tax increases did not occur during aligned government periods. They were not aligned governments that put through these tax increases. So we need to stop stereotyping quite so much and recognize, A, if a tax increase goes through, it's going to have some microeconomic consequences. I don't think I'd want to have the Rolls-Royce dealership on Marco Island or be selling Rolex watches in New York necessarily. But for businesses that sell to Main Street or sell to consumers in general that have broad appeal, or for businesses that know how to pivot when the market shifts like that, we really don't have to worry about these tax increases. That doesn't mean you and I or other high net worth or high income individuals don't have to worry, but at a macroeconomic level, it's going to be okay. You're going to be okay. So take that concern off the plate. Now, increasing corporate taxes is a different deal. President Biden wants to increase our tax rate up to 28% from current 21%. That's going to give us an international effective combined rate of a little higher than that of France. And that's not a place you want to go. But it's not a place we haven't been. Before the Trump tax cuts were put into effect, that's where we were. So we're going to be going back to where we were. And that is the best possible spin I can put on this, because for the last 40 years, globally, every part of the world, every decade, the trend has been to lower corporate taxes. And you get a sense of that off of this. So to put through this sort of an increase in corporate taxes is very counter global trend. And when you go counter global trend, you have to ask yourself, am I setting up some competitive disadvantages that we are going to have to overcome? And it isn't just the top income tax rate for corporations, it's the increasing the minimum tax and the country by country foreign tax and a whole host of other things that we think, we're concerned anyways, will make it more difficult in the out years of increasing these taxes for profits to gain significant upside momentum. So if I'm looking for an exit scenario, this clearly has to be one of the things I consider. And it has nothing to do with a return 65 or return 70. Scott wanted me to come in with when do I think it could happen? You know, the body politic is a funny place. Could it be 22? Sure, it could be 22. Maybe it'll be 23, 24. Don't really know. All I know is that we need to be presenting our businesses to market, if we're so interested, with this in mind, and understanding that it's the bottom, the net that Scott was referring to, that really matters. So between higher income taxes and higher corporate taxes, this is a government that seems intent upon taking from one sector, playing Robin Hood, and giving it to the other sector. One of the ways they want to do that is by increasing the capital gains tax rate, right? They want the max rate to now be 40%. I tend to like long-term histories, but there's a point to this one. We haven't looked at this. Goes back to 1922. To go to 40% is unheard of. And the calamity, I think, is that I'll bet you donuts to dollars, they're thinking, okay, we're going to take money out of the wealthy people's hands that experience these capital gains, because it's not your ordinary Joe that worries about this, right? And we're going to tax it, and we're going to put it where it belongs in the economy. Except when you look at the data history, people who experience capital gains, turns out they're smart. When the capital gain tax goes up, and I'm going back to the 70s now, they won't recognize the capital gain. They'll sit tight. They'll sit on their hands because they will know eventually that tax comes down. So they'll wait it out. And when the tax comes down, then you see a lot more capital gains realized. The unfortunate part of that is the government's going to be spending the money assuming increased revenue that isn't actually there. And that's going to make our debt situation a little worse. And I'm also all upset. It's economically a significant move when you go from step-up basis being 100% to 0% like that. That's a big deal. And the qualified business income going away over a certain threshold, and the 1031 exchanges going away. These are all significant changes that need to be addressed as we think about our businesses and when to get out, juxtaposed against the business cycle. Okay, and there's a lot of moving pieces in here. I'm going to be talking a little bit more about that business cycle in just a few moments. Here's the bet. And at ITR, we were saying, Republican or Democrat, we didn't care. Our bet was that red line was going to continue to go up because it was a pretty easy trend to see. And the higher that debt goes, the more angst people are going to have, understandably. So I want to take some of that concern off your plate right now. Raising or increasing our national debt right now isn't wrong in terms of ruining the economy. It isn't a cause for thinking our economy is going to come tumbling down around us in the near term. That rising trend doesn't matter to you or me for 21, 22, 23, or 24. And the reason it doesn't matter in the short term, but it sure as heck matters in the long term, is this. It's the Federal Reserve's Federal Open Market Committee. These are the folks that determine where the Fed funds rate and the discount rate are trending. And each one of those little red dots is a voting member of the FOMC. And at their last meeting, which was December 20, they're going to have another one in March, they said no interest rate increases in 21. One voting member said, yeah, it might go up 25 bips in 2022. And 5 said, yeah, probably see anywhere from 25 to maybe a total of 100 bip rise by sometime in 23. I think personally they're being optimistic, but it is describing an accurate low interest rate environment. You should be working that to your advantage. Man, if I was going to be doing a deal, if I was a buyer, I'd be leveraging the heck out of making that acquisition because this money is so dirt cheap. There is going to be inflation out there in the future. But the multiples that you can get today and these interest rates, I'll keep my own powder dry, thank you very much. I'd rather use somebody else's. Now, the Fed is saying that they can keep interest rates this low because they don't see any inflation. And when they say that is at the consumer price index or the PCE deflator, both. And they're right, there isn't any inflation in the CPI, and there won't be hardly any in 21, 22, and maybe even 23, although I think there may be a little bit more in 23 than they're anticipating. There's two reasons for that, and we're not going to go into the thicket of all that, but suffice it to say that we think they're right. And that it'll be post 22, maybe even post 23 before inflation really starts to rear its ugly head again. That's a significant distinction in our world. Low interest rate environment for the next 3, maybe 4 years, then the interest rates start creeping up with inflation. And in the second half of this decade, you're going to be contending with higher and higher interest rates because you're going to be looking at higher CPI inflation. One of the triggers for that, just, I didn't want to get into the thicket, is when the asset price bubbles burst. And the two asset price bubbles we're dealing with right now are real estate prices and the stock market. When those let out some air, then you're going to tend to see more of that CPI inflation. And the more the government plays take from the rich to give to the poor, the more inflation you're building into the future. Very easy road signs to be looking at. We're looking at the yield curve every single day. When that blue line drops below zero, that's the inverse yield curve or negative yield curve, any way you want to think about it. But right now it's clearly moving up. It's a good indicator. The timing is not terribly consistent with this. It's not one of our favorites from a timing standpoint, but as a sledgehammer goes, it's pretty worthwhile. When it drops below zero, you know you're going to have pain being the recessions indicated in gray. And when it's rising, this is the world bond market saying we see the US economy getting stronger for the next 18 months at least. That's cool. That's significant. The bond market sees further into the future and is a lot more accurate than is the stock market, by the way. And the other thing the bond market is telling you and me right now is we're not concerned about all the debt the federal government is racking up. We're just not. It's a non-issue right now. One of the things I've learned in my 40 years doing this gig is that you don't fight the Fed. They're going to get their way, at least in the near term. For the near term means the next 2, maybe 3 years. And you listen to the bond market. The bond market says, take your concerns about the deficit and put them to one side. Do not let that concern factor into whether you want to make a major financial move or not, whether the economy is going to be coming down around your heels. I'm going to be doing my best to show you this economy of ours is poised to go. Another sign we have for the value going up, besides the overall economy turning around, is these bond yields, which lead by 6 months. This is a rate of change, and I'm going to better define the rates of change in a little bit, but a 12 over 12 rate of change is annual average data for a 12-month period, right, compared to the same 12-month period 1 year earlier. And the 312 is taking quarterly data, comparing it to the same quarter 3 months earlier. And yes, we're getting some rate of change signal, but we're way below the zero line rate of change rise signal. So it's just a favorable leading indicator. When that green line bond yield starts breaking above that zero, that's when you know you're getting into the inflation realm. And while the data isn't rock solid, the analysis suggests that multiples become compressed when there is inflation out there. When these interest rates get high enough, you start seeing multiple compression, which says if you want to avoid multiples being compressed, you're better off making your move in the first half of this decade rather than late in this decade. Just something to keep in mind. Global trends that matter. I wonder how many people know this or don't know this. The US is the biggest economy on the planet. We're the best economy on the planet. We account for 24.6% of global GDP. China's number 2 at 16.5%, followed by Japan, which used to be number 2, followed by Germany, which used to be number 3. Now India is number 5. They just beat out the UK with the latest data. Here's the takeaway. This is the biggest economic market. We don't have the most people, but we are the biggest economic market, single market. And when you look at the major factors that dominate economics and dominate the future, and those being demographics, natural resources, and having the rule of law, those are the 3 biggies. The United States is going to stay the world's #1 economy for at least the next 80 years, if not the next 80 plus years. All right. China's best days are in its rearview mirror. China's not going to become the United States of America. Nobody on this map has the ability right now, and won't for the next 75 years, to become the next United States of America based on those 3 basic economic tenets. So that should help some of your thinking about, is this a good place to be investing, or should I be investing in Spain or South Korea or Russia, heaven forbid? Invest in Russia? Yet, comrade, do not go there. You know, there's this impression I find all the time that, you know, people think that Chinese buying up America, that's the most politically correct way I can think of to say it. China's number 13 on the hit parade list. In 2019, amounting for only $4.3 billion. Germany was the number one source of cash coming into the United States. And this isn't foreign cash coming in on our stock market. This isn't governments coming in buying debt. This is German businesses coming in and buying business assets. Japanese businesses coming in. Canada, UK, Bermuda's a financial play that's coming in through the offshore banking accounts. Heck, Australia was almost 4 times as much as the Chinese accounted for in terms of investments. The world isn't changing as rapidly as you think. And when you think about where our US businesses are investing, China is about where Switzerland is on this map here in terms of middle of the road. And where you see Luxembourg, that's where Mexico shows up. We're investing, US businesses are investing most heavily in the UK, Germany, and Singapore. And then it goes through the Canary Islands and then goes on into some other European entities. This world isn't as crazy as you think. Expect a couple of things to be going on all around you in a very subtle way, but related to this. Nationalism is displacing globalization. And as it does, that breeds future inflation. Nationalism is also dictating people are moving towards shorter and shorter supply chains. And there are lots of studies out about how China's cost basis is not that much better than the US. And as a reliable partner, they're not there. Vietnam has a better cost base than us. But as far as being a reliable part of the supply chain, they rank very low, as does Mexico. The US ranks very high as reliability. And you're going to find that this administration of ours is building into their tax codes that there's a tax credit for manufacturing in the US, and there's a tax penalty for manufacturing outside the US. So look for the reshoring effort to be very real and for it to continue. And there's just a fun fact, and I'm going to leave it alone after this, but China, beginning in 2021, is losing about 200 million workers every 15 years. So they're going to lose about 400 million workers over the course of 30 years, because that's how you need to think about demographics, is in 25, 30-year blocks. That's 400 fewer consumers for which we have to contend with. It's also 400 fewer manufacturers or laborers, but 400 fewer consumers in China also. Really, demographically, this is a killer. And India goes through that around the year 2060. The United States alone, amongst the industrialized nations, has this growing population base. Coming back to the US, this is GDP, my friends. And the blue is actual results. The green are our forecast points. And you see that thump in 2Q 2020 came up in the third quarter because it came up nicely. The economy wasn't broken. It was just told to pull over by the political police. And fourth quarter, it came up higher. And it's going to continue to rise in 2021. And we have in 2022, we're reaching new record high territory. And it's going to take that long because it's going to take a while for travel, tourism, restaurants, retail to come back. To give us that absolute growth. So here's your takeaway on this so far. Go back to 2008, 2009, and remember those conditions, how people were fearful, they didn't know what was going on for different reasons. And there's a general consensus that the US is not going to be able to regain its preeminence, its dominance, which obviously didn't pan out that way. So the challenge you face is, all right, go back in time. What opportunities do I wish I had taken advantage of? What mistakes did I make back then that I am not going to make this time around? Because ITR Economics is now telling you that 24 is going to be a rising trend. We think 25 most likely is going to be another year of rise. And the next recession we face in the US is likely 2026. Now I'm going to cut right to the chase. If I'm interested in avoiding going through another recession because I just don't want to be involved in that anymore, then you want to be selling your business in 2024 or 25 at the latest, which means you got to be working at positioning it for sale now. If you can't see your way through the taxes are really going to be onerous as we get into that 2025 timeframe. So again, you probably want to be pulling that ripcord sooner rather than later. We used to tell people, maybe you have until 2029. I think 2029 is going to be a great time to sell again, but I think 2025 is the more optimal time if you want to really get the best multiples on your business. Because post 2025, unless there's a change in thinking in Washington, which we're not forecasting will occur, the tax increases you and I just looked at, that's just the beginning. Because as interest rates go up, carrying that much debt becomes more and more of a burden. Very quickly, how do you look at or read rate of change, calculate rate of change? You start with the monthly data. Could be your sales, could be the acquisition targets, sales, doesn't matter, revenues, orders, shipments, whatever you want to call it. And you simply compare December 2020 to December 2019, and that gives us a 1/12 rate of change. And then we run a 3-month moving total, which is taking 3 months worth of data, comparing it to the same 3-month year ago period. You see how low the numbers were in 2Q when we were going through the worst of the COVID. It's coming back up now. In fact, it's just about where we were before we dove into COVID. And the rates of change also hit their worst point in 2Q, and you can see they're pretty much back to normal. And now we run a 12-month moving total, which is 12 months worth of data compared to 1 year ago, and we run that 12/12 rate of change. You can get this off of our website. You can do this by getting an intern that knows Excel, or one of your children that knows Excel. Run these rates of change on your own businesses or on your target company. Find out where they are in the cycle. And when those 1/12 and 3/12 rates of change are running above the 12/12, if they're currently moving downward, and a lot of them still are, they're on the cusp of going up. That's the really sweet spot, right? Because most businesses are financially strapped for cash, not on the downstroke of the business cycle, but on the initial stages of the rise, because they don't have the working capital, they don't have the cash flow that a recovery trend takes. That's when they're most vulnerable. There's still time to be out there being eagle capitalists. This is to show you one of those signs here. You're looking at a 1/12 rate of change for U.S. industrial production. It's running above the 12/12. So yeah, industrial activity in the United States in general is down 1.3% in the latest month, which is January compared to 1 year ago. The last 12 months were down 6.9%, but notice on this chart, when the black line, which is the 1/12, rises above the blue line, we got a shift of momentum coming. And as long as the leading indicators are supporting it, it's going to happen. Maybe you're into wholesale trade. Maybe that's your realm within the economy. This is wholesale trade excluding petroleum, metals, and minerals. You can slice and dice this any number of ways, but wholesale trade is, over the last 12 months, just barely below where it was pre-COVID. And the leading indicators are telling us it's about to bust open, along with overall U.S. industrial activity. Our leading indicator dashboard is green, up and down green. And you can see under macro indication what that means. It tells you how far into the future, mathematically speaking, reliably speaking, you can be upbeat about the economy. The only thing that's going to derail this economy, I'm convinced, is if one of those variants, COVID variants, causes such a bloom that politicians feel obliged to tell us to turn off the economy again for our own safety. Barring that or some other black swan, like a massive cyber attack, this is going to happen. And you can't run your life based on black swan events that could happen. You go with the preponderance of evidence, and the evidence is rise. Look at the consumer, retail sales. The upper portion of the chart of the rates of change is scaled on the left underneath ROC for rate of change. Through January, the 3 months ending January 2021, we're at 4.0% from before COVID. We're back. We completely recovered from COVID. Look at the data trend on the bottom. The thinner black line is the 3-month moving total. We had some seasonal rise in the fourth quarter. You can see the seasonality in retail sales. And in January, because that's traditionally a soft month when we return our Christmas presents, you see it go down. And that green line, which takes all seasonality out of it, is clearly rising. And it didn't go nearly as bad as it did during the 2008, 2009 decline. It wasn't nearly as severe because the economy right now and in 2020 was not broken. It was just put on pause, like you can do on your DVR. Consumer has a lot of firepower. This is disposable personal income. This is so after-tax income. A rise in the midst of COVID doesn't happen. I mean, a recession is you see disposable personal income go down and you spend quarters, if not years, climbing out of a hole. But you send $1,200 checks, $600 checks out to people. You add a spiff onto unemployment comp and you're going to get a consumer that has more money to spend than they did before the recession. Now, this is macroeconomic, right? Keep that in mind. Are there some people that didn't get enough money? Yes. But the government acted quickly, which means they had to take a shotgun approach rather than a rifle shot approach to getting money out there. They didn't know what they didn't know. The government deserves kudos for how fast they moved, not for how they moved. Now, the Biden administration's $1.9 trillion stimulus isn't going to have the same bang for the buck that you see here. One of the reasons is unemployment is way down. I'm sure you still run across people, I know I do, that say there's still tens of millions of people out of work because of COVID. No, there aren't. You look at how many people were unemployed pre-COVID, and then the unemployment rate soared to 14.5%. Now it's at 6.8%. Pre-COVID and where we stand today, there's about 4.3 million, call it 4.3 million people still unemployed because of COVID, not tens of millions. You cannot drive policy when you want people to believe effective policy, when you believe that there's tens of millions of people unemployed. What does that mean for you and me? It means if our businesses are labor intensive, we don't have a deep labor pool out there. It means that the people who are unemployed are going to be much slower to come back because they're in lodging, they're in restaurants, they're in entertainment, they're in travel, and that's going to be slower to come back because of COVID. But you can't just keep throwing money at this problem and expect the same results that we got in 2020. Primarily what's going to happen with the 1.9 trillion is you're going to increase the level of savings in the country, which will help keep interest rates low in the near term. It builds this huge cash pile that will be spent in the future. As a sign of the health of the economy, you can see single-family housing starts are on the rise. That's the blue line, and the triangles, those are our forecast points for housing by quarter going out there through 2023. Demographics are driving this, extremely low interest rates are driving this, and very low inventories are driving this. You look at economic fundamentals and demographics, and you see it's a pretty good world. The green line here is the 312 rate of change for business confidence, and we show that it leads M&A valuation values by 13 months. So there's two things I want you to notice on this. One, where's your business confidence? Are you lower than this, higher than this? Higher is fine, a little bit lower is fine, but if you're way behind this, it means you're not taking advantage of the opportunities because CapEx is happening now, it's recovering, consumer is happening, your confidence should be happening also. And we're just on the threshold of seeing total value of the M&A world starting to move back up again. A few words about people because people make it happen. You're looking at state population growth in the United States from 2015 through 2019. 20 data isn't available yet. The red states or pink states are ones that are losing people. West Virginia being their first one. West Virginia is our version of China. Illinois, losing people. New York, Vermont, Connecticut, New Jersey, and Mississippi, all losing people. Where you see the dark green, that's where the population is growing the most. And that tends to be where the most of the internal migration is happening. I'm I caution people about Washington and Oregon because we see that that pattern is decidedly slowing down. I think the new West Coast is Idaho down through Arizona and then on into Texas. Why am I showing you this? Because dang, I'll be a lot more optimistic about a business that does business that is focused. Its markets are focused in the southeastern region or maybe in the mountain states than up in the northeast. If there aren't people, you're not going to get the growth. It's as simple as that. PA, 0.1%. What do you suppose the prospects are for a lot of organic economic growth in Pennsylvania? And 0.1 is because 3 families had twins in the last month of 2020. So it gave them a 0.1%. And next year, it'll probably be negative. Next year, Louisiana will probably be negative also. Demographics matter a great deal. The other thing I want you to know about demographics, and I'll be happy to take questions on all of this, but there's this mindset out there that millennials are so much different than their forebears. And one of the ways that we could prove that they're different is they're getting married so much later in life. Don't go there, not so fast. The blue line is median age of first marriage, and you see the boomers, Gen Xers, and millennials. That trend was started by boomers beginning in the second half of the 1970s. And the delay experienced by the boomers and the Gen Xers is simply continued by the millennials. Turns out they're buying as many cars as their forebears did. 80% of millennials own a car or lease a car. They're having kids. About 2.3 years after they get married is when they start having their kids on average. I mean, they're remarkably like the Gen Xers and similar to the boomers. Do not despair about not understanding this future. They think differently, they have different priorities, but economically, they want the same thing that you and I wanted. Keywords on the financial markets. This is comparing the S&P 500, which is the thinner line, the lower one, that's brown, 3-month moving average, to total number of mergers and acquisitions, which is that thicker blue line. This is a very long history because sometimes I like to see if, well, I wonder if that relationship has changed through time. And the takeaway here is, no, it really doesn't change through time. I mean, the number is going to accelerate or decelerate in loose association with what's going on the stock market. Most recently, like back there, way back then, we had the stock market that really failed to grow from 2000 into 2011, 2012. And we see that same flatness in mergers and acquisitions, the number. There's a reason I'm pointing that out to you. Just hold on to it for a moment, but I'm going to be referencing that 2000 through 2012 period again. Right now, with the stock market going up, it's a favorable trend for us. And as long as that market continues to go up, those people who live in the M&A world, you're going to find yourselves busier going forward. That's cool. Here is the S&P 500 on log scale again, and it's continuing to rise. And I picked this title very specifically. This is a positive momentum market. This has nothing to do with economic fundamentals in the sense of corporate profitability or rational market capitalization. If it did, this situation wouldn't exist. The lower line is domestic profits in the United States. And that really hasn't grown since 2014. Yet that stock market has continued to go up and up, untethered from the reality of corporate profitability. There's a whole bunch of takeaways from this, but the largest one, I think, is you're looking at an asset price bubble that was created somehow, because history is pretty clear. That blue line is going to come down to match the green line because we don't have a chance of getting that green line up that fast, okay? And from a macroeconomics perspective, that's really easy to understand because of the tax increases. So believe it or not, when ITR gets involved in the due diligence process, the first thing I want to look at is not their top line, but how they manage that bottom line, because that's where the real art of management is, and that's where the real truth of a company is. And if you can understand why that profitability didn't grow in association with the top line, okay. But if you come out of the due diligence process and go, I don't know why their profitability isn't growing, that should factor into the valuations, obviously. You want an example of this? Tesla stock. And I'm not picking on Tesla. I own Tesla. It's a short-term play. It's not a long-term investment. But why is Tesla's market cap where it is when its profitability isn't there? When most people understand now that the technology that they use within Tesla for building all the batteries, the huge capital investments they've made, that technology is likely going to be pushed aside by solid state ion batteries in a matter of 6-7 years. The technological disruptions are going to keep coming. Look at profits. Just look for profits, because someday it's going to matter to you. And I think it matters in our industry right now. This is value again, not number, but value in blue line. And historically, there's been these very strong peaks, and there's really been an ascending peak-to-peak relationship. But with profits no longer ascending, we're not seeing the values ascend. So my concern is that in the second half of this decade, when profits are coming under more downside pressure and the stock market is likely to be underperforming, then some of us may have wished that we pulled the ripcord in 2024 or 2025 or even before. I think there's safety in doing it sooner rather than later. And one of the reasons we say that is, and I'm going to go back to this slide, see that period, that flatness that I referred to before between 2000 and 2011. One of the hallmarks of that period was the US dollar being in secular decline. The USD is in cyclical decline now through 1Q 2022. And that may alter your thinking about some companies all by itself. But our analysis, and we did a deep, thorough analysis, is that the odds of the dollar being in long-term decline, not linear, nothing's ever linear in our world, except man-made stuff, but not linear, but long-term decline for the US dollar will likely be a hallmark of this decade. And that means several things. It means that putting most of your money into the S&P 500 isn't going to be how you're going to really increase your wealth. It means that you want to be looking at alternative investments. It means commodity prices are going to be going up rapidly, particularly in the second half of this decade. And that's going to impact how well businesses do, where they're positioned. Do they take advantage of rising commodity prices, or do they get hurt by rising input prices? What's driving this bubble is Federal Reserve. This is the anatomy of an asset price bubble. When the Federal Reserve turns on the money supply spigot, that brown line goes up, and they did that back in late 2010. 18 months later, the stock market hits a bona fide low and has a great and glorious cycle. It was in 2014, the Federal Reserve turned on the money supply spigot again. Not a whole lot, didn't take much because it didn't come down much. 15 months later, the stock market, nice new cycle. In early 2019, the Federal Reserve, long before COVID, had started ramping up the money supply again to get the economy a little kick. And you see 15 months later, the stock market is going up. We're living the dream. We're living a liquidity dream right now. But this rising trend in the brown line, the money supply, isn't going to continue forever. It never does. It cannot continue forever. And when it reverses direction, you, me, we're all going to know that that means that liquidity is going to become more scarce. It means the stock market is likely to be going in a negative direction, and circumstances for M&A life are going to become more challenging. Not impossible, just more challenging. We're living the dream right now with this brown line. What we do is follow this brown line for people because, we're nerds. We don't have much else to do. One other chart I want you to see is our own ITR financial leading indicator is supporting what all these different systems have been saying. Values are likely to be going up. May not be going up linearly is the takeaway here because there's that COVID chunk out there, but the general trend is going to be one of rise, and I think that's going to last into 2025 right now as we sit here. I mentioned 29 is a good time to sell, and Scott was kind enough to mention our book, Prosperity in the Age of Decline. For those of you familiar with our long-term premise, we are looking at a very difficult economic environment between 2030 and 2036. And you do not want to be owning hard assets. You do not want to be owning businesses that aren't necessary, necessities of life, because we're going to be switching from inflation to deflation, and we're going to be looking at very high rates of unemployment for about 2030 through 2036, and that bottom occurs in 2036. That's an entirely different webinar. I just want you to have it in mind, and why that's the justification for my thinking. 2029 is my secondary go-to for getting out, but I'd rather do it sooner rather than later. But certainly, if you're young or you just don't want to give it up right now, think long and hard about holding on to the business beyond 2029. And Scott, we're going to go to you for questions. I just want to make this offer for your people. If they text TR space offer to that number, for 90 days, they can get free access to our trends report. And it's all on demand, which means you download our app and you just pull it up on your phone. So a leading indicator comes out, we run the analysis, and we'll populate it. You can check on the money supply yourself for free for the next 90 days. See if it isn't working out this way, if we aren't building some additional momentum for recovery. Please stop letting yourselves get caught up in the headlines. The headlines, it's not the real story. They're oftentimes so misleading. The reality is the consumer has money, businesses are confident, and we are good to go. The administration wants us to think otherwise, but most administrations do. That's how they derive their power. And I'm telling you, we need to think through that and plan for a nice rising trend on the other side of all this COVID concern. So, oops, I should have done this first. Here we go. It should be coming back online, Scott.
Brian, thank you so much. That was great. I can see why Nicolay recommended you so strongly to have you speak to us. It was really a lot of great insights there. I got a lot of notes. A couple questions for you that we have. You talked about, and thank you for the offer of having people look at, be able to get your resources. Again, have your kind of predictability success is unbelievable. But I know you and I were talking offline that there's a lot of places that people go that they think they're pretty sophisticated, and they go to different trends or different reports to get their data. And you've told me that a lot of those are just not great places to go. Maybe just mention a couple of those that people think are pretty popular that might not be great reports to make business decisions on.
Well, I will comply with your wish, Scott, but before I want to reset a little bit, please. I read all the same news sources that I'm about to allude to, but I don't read the headline, I read the articles. Okay, so it's more than looking at the picture, you got to actually read the article. And I read people that I don't agree with, who I think are likely going to be wrong, but I got to understand where they're coming from to ask myself if I'm wrong. So you want a preponderance of input. But I have found the Wall Street Journal, which was, when I was, a young man, the source, they're prone to, if you didn't like that slant today, just wait a few days, you'll get the other slant that you like on that particular article. They enjoy selling newspapers, quote unquote. I find that Bloomberg has great data, but they tend to be a little bit too flamboyant with the analysis, if you will, and not as much rooted in hard thinking. I tend to like Barron's. I read The Economist. The various and sundry outlets are rated for objectivity. Who is rated the highest? USA Today is rated the highest in terms of objectivity of delivery, headlines, and the rest of it. But that may be because they cover a lot of the entertainment sector rather than just the business sector. Have a broad source of inputs. Find one you can sort of center yourself on, but never look at just one source. You have to look at the preponderance of evidence. We do. And we try and distill it down into the most logical course of action.
Great, thank you for that. Another question, I think you mentioned earlier that, with capital gains that people, if it rises up, you can maybe hold on and then eventually it'll come back down. But with everything going on with the baby boomers and Social Security and Medicare, Medicaid, do you think in the next 10 years that rates are going to be any lower than they are today? Or do you think if they go up, they are going to come back down in the next 10 years? Or what are your thoughts with capital gains over the next decade?
They're not going to be any lower than they are today is what my long-term prognostication is, Scott. I'm pretty confident they're going to go up. If history trends the way it usually trends, they're going to stay up for at least 4 years, could very well be 8 years before you see some action of decline going on. But the pressure is going to be intense not to do that even beyond 8 years, simply because we are going to be in so much debt that the government is not going to be able to stop spending. So they're going to be reticent about giving up a perceived revenue source.
Got it. And I just want to make sure I understood this right. When you talked about all the different things that you look at, that between now and 25 is probably a better time, all things being considered equal, a better time to sell than 26 through 30. Is that correct? Or the multiples will be stronger? Is cash cheaper and everything else? Or debt's cheaper?
Yeah,
Excuse me.
when I look all in, that's what I come up with, Scott. And before getting ready for this webinar and spending a lot of time researching, I wouldn't have necessarily have said that, but with the margin compression and with the severity of the business cycle decline that we see happening in 26 and on into 2027, if you're thinking about getting out anyways, why put yourself through another recession? Why not just find yourself a nice beach or a nice golf course and be done with it if you were thinking about selling your business anyways? Great.
And then if you're talking to the business owners, any thoughts on what they could do to take advantage, what's maybe one thing that a business owner could do to take advantage of the current trends over the next 3 to 5 years? Any thoughts there?
Borrow money to invest in yourself or for an acquisition. But in terms of investing in yourself or for yourself in a business, it's get as many processes as you can automated, because there's wage inflation in our future. Make sure your training programs are excellent and that the continuous improvement of your people is one of your mantras. If you're going to keep millennials engaged, it's because you're constantly training them, challenging them, and they're going to want more money, so they might as well be more efficient for you at the same time. So that's going to be built into your culture as well. And you might as well get all that going by borrowing some money. Just make sure by 2029 you're out of debt. That's the admonition there. You don't stay in debt. You kickstart this process now, but in 7 years, try and get out of that debt.
And I know in your book, it talks about that 2030 period, thereabout of this Great Depression or some things going on. Maybe just take a minute just to talk about, what are some of those things that are probably going to trigger, that type of an environment 10 years from now or so?
Sure, happy. Healthcare costs continuing to rise without getting a break, because we're not about to change our culture, and that's what's driving the healthcare costs. Everything else is just periphery. Social Security, even with the Biden's proposed tax increase on Social Security, the Social Security trustees say that's a Band-Aid. We're still in the soup come the latter part of this decade. It doesn't get us anywhere, because the only way you're going to solve Social Security is by raising the retirement age and or cutting back on benefits, and that's the political third rail that isn't going to happen until most of us baby boomers are gone or no longer able to vote by mail or something. Inflation has always been a concern, and actually that's a heightened concern now, Scott, because of the sheer magnitude of fiat currency that's been created by the Federal Reserve and all these other inflationary logs that are being placed on top of that fiat currency. We're going to see more inflation than we thought was going to be happening. And then finally, it was also predicated on demographics. And aging people cost a lot of money, and they don't put as much money back into the system. Fortunately, we get younger after 2036, at least younger relative to all of our major trading partners. And then when it came to the debt, in the book we talk about the debt an awful lot, and I can further refine that for you by saying It's not the size of the debt, it's how long will the world be willing to lend us that money. And that's one of the double-edged sword aspects of nationalism. Nationalism is going to help boost the domestic economy going forward. Get that. But there are unintended consequences to most things in economics. And one of the ones that we're concerned about is it's increasing nationalism and just China. Why is China going to continue to lend us money to support our lifestyle if we have diminished their entry into the US market? What is in it for them? That they're going to be altruistic about it? And if it's not China, I showed you the wheel, the pie chart. Who else is going to step up with the kind of money that we're looking for? The Federal Reserve could create it out of thin air, but that just gets you more inflation, and that gets you ultimately into an even deeper hole down the road. I've been doing some work on fiscal gap analysis, and the numbers are truly frightening. I am scared to death about the size of our deficit, just not for the next 3 or 4 years. It's a further down the road us problem.
Got it. Well, thank you so much. This was so insightful and right on the mark of, I think, what our business owners need to hear to make some smart decisions and the trusted advisors to help with their clients. So I want to thank you, Brian, again, and ITR Economics, and thank you so much for the generous offer that you gave everyone that sends you an email. I would absolutely say take him up on this. It's great information. Will help you in your business as you move forward. We're going to take a break now. And again, take the time to chat with other people in here. Make sure you click on your next breakout session and look at the other speakers and sponsors while we have some time. Thank you, Brian. Have a great day.
Thank you, Scott, very, very much.